Hi, welcome to Market Metal. Three magical words of an investor are margin of safety. This means that when you buy a stock, you should purchase it below its intrinsic value and always maintain a margin of safety. But here's the challenge. If you don't know how to calculate the intrinsic value, how will you determine the margin of safety? In today's video, I'm going to explain how to calculate the real value of any stock. This will help you understand whether the stock's current market price is overvalued or undervalued. I'll break it down in the simplest way possible so even someone completely new to the world of finance can understand it. I guarantee this knowledge will help you increase your profitability and reduce your losses. But remember, your profit isn't determined by the price you sell, but by the price you buy. If you haven't liked the video yet, please like and subscribe to Market Metal. Let's begin. First, we need to understand that price and value are two different things. In the stock market, stocks aren't sold, they are auctioned and go to the highest bidder. In India, the two major stock exchanges are NSE and BSE, where around 7,000 to 8,000 companies are listed. Among these, the popular or the trending stocks are often sold at a premium, while the lesser known low profile stocks, those don't get media attention, are usually priced lower. These undervalued stocks can potentially offer great investment opportunities. Today, it is easy to find the current price of any share online, but the real challenge lies in calculating its intrinsic value. This is what tells us whether the current price is overvalued or undervalued. All great investors follow this principle. When they evaluate a company for investment, they don't start looking at the current market price. Instead, they manually calculate the company's valuation or, in simple terms, determine its intrinsic value without considering the current price. This helps them stay unbiased in their analysis. To understand this, let's take an example of a business that's not listed on the stock market. A very good friend of mine, Raju, has saved a significant amount of money through years of hard work and discipline. Now, he is exploring ways to invest that money not just to beat inflation but also to avoid falling into a trap of the so called safe and secure returns. To know more about inflation and the trap of investment, check out the previous video where we have discussed this in detail. The link is in the description. India, being a high potential economy, offers a wide range of investment opportunities. Let's break them down one by one. Bank fixed deposits offer an approximate 4% interest rate, often barely enough to beat inflation. Gold and silver historical yield around 8% to 10% return but comes with storage and security costs. Government bonds backed by the government, these are highly secure and offers around 8% interest rate. Mutual funds typically generate return between 12 to 15% depending upon the fund type and the market condition. And finally, we come to one of the most rewarding yet challenging avenues, entrepreneurship. You can either run a business entirely on your own or become a part owner through equity investment. Since Raju was looking for opportunities that could offer returns higher than 20%, we began exploring options to start a business. One evening, we met at our usual hangout, a cozy cafe run by an elderly couple in our neighborhood. They have been running this place for years, and we have been a regular visitor for as long as we can remember. That evening, the couple approached us for a chat. They shared they were planning to close the cafe as age was catching up and they were preparing to move abroad to live with their children. Our eyes lit up. This cafe is always buzzing with customers serving high quality food and has built a solid reputation for their excellent customer service. We asked the couple to share their financial records for the past 15 years, and we also conducted our own research to get unbiased feedback on their food and service. What we found was encouraging. They had a strong base of regular customers, and the new ones kept coming consistently. Their financials showed the cafe has been consistently profitable over the years. Based on this, we concluded that this is a solid business opportunity, one that has been profitable and showed strong potentials to continue generating returns. Here's a pro tip. Whenever you plan to invest in any stock or a business, it's crucial to perform the quality analysis of the company first on their product and services. Look into the market feedback of their products, credibility of and the vision and mission of the promoters, and the overall business model. Now, let's calculate the intrinsic value of this cafe. The cafe earns a yearly profit of rupees 25 lakhs. We also observed that most customers pay through cash or UPI with very little credit involved. This means that the reported profit is largely converted into actual cash flow. In financial terms, this is called cash flow from operating activities. From our earlier quality analysis, we also found that this business carries low risk, making even a moderate return is an attractive outcome. However, since we previously explored other investment avenues, we should expect this cafe to deliver better returns than those we previously explored. So for our calculation, let's assume a required rate of 25%. A simple way to estimate the value of this business is to divide its annual cash flow of 25 lakhs by the required rate of return. That is, intrinsic value is equal to cash flow divided by the required rate of return. Pro tip: net profit and cash flow are two different things. Net profit is the surplus after deducting all expenses and taxes. Cash flow, on the other hand, refers to the actual money received by the business. You might show profit on paper, but still have not received your payment. And if money haven't been received, it won't show up in the cash flow. As we all know, cash is king. That's why cash flow is a more reliable indicator when assessing the business's true value. So in this case, since there is no credit involved, we'll take 25 lakhs as an annual cash flow and divide it by the required rate of return. That is 25 lakhs divided by 0.25 is equal to 1 crore. Let me explain what this means. Imagine you buy this cafe for 1 crore and it gives you a regular cash flow of 25 lakh every year. That's 25% return on your investment, which you're earning annually. This method of valuation is called as DCF or discounted cash flow. It means you are discounting all future profits and bringing them to their present value. Now, this might sound overwhelming. Let me explain. In compounding, we calculate how money grows over time. For example, if you have 1000 rupees today and compound it at 20%, it will become 1200 after 1 year, 1440 after 2 years, and so on. But discounting is a reverse of compounding. We ask what is the present value of the future amount. So, if you expect to receive 1200 next year and your required return is 20%, then the present value of that future amount is 1000. Why? Because time has value in life and in finance. Here is a simple example. If I offer you two options, take 1000 rupees today or take 1000 rupees next year, you would choose option 1 because even if you put 1000 rupees in a savings account, you would earn 3 to 4% interest, turning it into 1030 or 1040 by next year. So the key takeaway is the intrinsic value of rupees 1000 received next year is lesser than the intrinsic value of rupees 1000 received today. That is the foundation of discounted cash flow, valuing future earnings based on today's money.
So this new business, Good Times Cafe, will generate a consistent profit of 25 lakh rupees every year. So now let's look at the current intrinsic value of all these future profits generated year on year. The intrinsic value of 25 lakh rupees to be received at the end of first year is 20 lakhs, and the current intrinsic value of the second year's 25 lakhs will be slightly lesser than the first year's 25 lakhs, amounting to 16 lakhs, and the third year's 25 lakhs will be even lesser and will amount to 12.8 lakhs. So the current intrinsic value of all the 25 lakh rupees that will be received year on year in the future will be lesser and lesser. Even if the cafe continues to generate 25 lakh rupees of profit every year for the next 100 years, each profit will worth lesser in today's term. Over a long term, the value of the future cash flow decreases but doesn't become zero. And the fun fact, if you add up all the discounted values of these future profits, we will arrive at the same number we calculated earlier, 1 crore. This brings us to the golden rule of valuation. The value of any asset is the present value of all expected future cash flows. Had I said this in the beginning, it might have sounded very complex. But now it's very easy to understand. In our case, the value of the cafe is simply the amount we are willing to pay today in exchange of the future cash flow it will generate. Now is the perfect time for us to understand price to earning, or commonly known PE ratio. Here is how PE ratio is calculated: price divided by earning. In our case, the price that we are willing to pay is 1 crore for an expected return of 25 lakh rupees at the rate of 25% per annum. That makes our PE ratio 4. Now, let's say the older couple doesn't agree to sell the cafe at 1 crore. They feel the business is worth much more given the effort and hardship they have put into building it. So, we lower our required rate of return and recalculate the intrinsic value. At 20%, the new value is 1 crore 25 lakhs and our new PE becomes 5. At 19%, the value increases to 1 crore 31 lakhs and the PE ratio becomes 1.26. Now, this is a very important insight. The lower you expected return, the higher the price you are willing to pay for the same profit. Pro tip: your profit doesn't come from selling at a higher price, it comes from buying at a lower price. In the real market, you don't need to calculate everything manually. You can easily find the current market price and the PE ratio of any stock in most stock screeners and financial websites. These tools help you identify overvalued and undervalued stocks so you can pick the right stock at the right valuation. Now that you have watched this video till the end, I am confident you won't make these common mistakes of buying overvalued stocks. If you found this video helpful and insightful, please take a moment to like, share, and subscribe to Market Metal. Thank you so much for giving your valuable time. See you in the next video.